get to that situation. We know that on October 31st, where we had this kind of this vicious candle right here that started to move down, reacting to the failures of the or the faults of the Euro agreement. We had a predicted low there at 1260, and 20 points below that. That means that I would be exiting at 1240 the next day on November the 1st. So from 1155 where we bought, 1240 where we sold, not a bad trade. And we'd like to, be able to catch every move, and like every move to develop and unfold this way. They don't all. In this case, we would have gotten out. We would have had a nice profit. But by the same token, we would have said, okay, our strategy says that if it drops 40 points below that predicted low of 1260, we would be in, and that means we would have been in right here at 1220. And of course, at 1220, as you can see, that quickly turned into a loss. That's why we want to keep the losses, relatively small. If we can keep them to a few points, then we can, survive as a trader. We try to make the trades when we can, make the profits when we can, cut the losses when we don't have the trade that is going to move. So it turned into a loss in that case. Now, just to move ahead, again, we're moving through a triangle right now, or into kind of that point of the triangle. So when we look at what we could do, where we're at today, and as to what are we going to do, the last trade situation that we had, or the previous trade situation that we had, was the predicted low on November the 9th. The predicted low on November the 9th was 1257. 40 points below that means we would be short at 1217. Now, it took a little while for that to occur, and it doesn't show up on this chart because the 1217 occurred today. We had another big drop in price today, went through this 1217 area below the predicted range, and that means that you would now be short at 1217. You would have your stop at 1237 in case it turns around and goes back up again, because you don't want to lose more than that amount in the market. It's very fickle, but we don't want to try to outguess the market, outpredict it, or anything like that. We just want to make sure that when we do get that opportunity, that we can be there, and maybe it'll turn into something, but if it doesn't, we want to cut our losses short. Of course, today also, we could say that, well, if we wanted to go long, we would also have an order, potential order, that could be above this predicted high for today, for November 17th. That predicted high was at 1247, and that means you would be a buyer 40 points higher at 1287. Of course, that puts you right in the vicinity of this previous high that we had up here, where we had this forming, on that kind of a unusual candle that we had based upon the Euro agreement. So that would put you right up there. It would put you in a high pressure situation again, where it's going to be pushing down. There's going to be more resistance at that level to exceed that high. But that's why I say it serves as kind of a benchmark. Moves above that, yes, you do have the possibility of moving on higher, but you have to get through that pressure before it occurs. You can't anticipate it will, you can't guess it will. You got to wait for whatever's going to happen. Now, we want to turn to a couple of other markets. We don't want to, everything that we showed you on the E-mini chart, you can apply to some other markets with the various, indicators and so forth. But let's go to the U.S. dollar. The U.S. dollar index, as you know, it tends to go opposite of many markets. U.S. dollar index is stronger, as it has been the last few days, and has moved up. Well, normally what happens is that the other markets, and that includes the stock indexes, a lot of commodities, various other markets, they tend to be lower. Well, we know that if we were doing this particular market, we would have gotten into the U.S. dollar index from this area about the same type that when the stock market, the E-mini, was sinking. October 31st, the predicted high for the U.S. dollar was 75.59. Using, again, the average daily range and a rough approximation of the average daily range, and not necessarily the exact average daily range, but using a rough approximation for the average daily range of 1 or 100 basis points, then we would be a buyer at 76.59, which occurred, that same day. Would have been in the market, maybe in this vicinity right in here. Now, as the market moves on up, you never want to lose more than where you've got in. You want to be at a break-even point as soon as you can possibly get. But when it does move up high enough, again, you want to have your stop 20 points or one half of the trading range, which is 50 basis points below the predicted low to get out of the market. It could have kicked you out at several different places along the way. But if you're still in, you're still using the market's money, when the market's going up and you have a profit, you can have a little bit more latitude to play with the market's money than if you're if it's coming out of your own pocket directly. So you might want to hang in there and see what's going to happen. Besides, all the pundits are saying the dollar has to go up and all that. I know you shouldn't listen to them, but it's hard not to sometimes to think about what they're thinking. But our current stop, if we were in this type of situation, using this current day that we have here today, this November 17th predicted low is at 77.89. 50 points below that would mean that we would exit at 77.39. We don't know, if this is going to be long lasting. You can tell by looking at the predicted differences. They're still on the strong side, but pretty much kind of waffling sideways. Not as good a clue as it was in the crossover, but it just means that the oomph is a little less than it was as the trend started. But you will note that the blue line, that predicted difference, and you'll note the blue line here, is above the actual moving average. And so at this point, you have to say the trend is up, and you want to stay with that trend if you're a trend following type trader. Now, the market to keep an eye on, or at least I think it's a possibility to keep an eye on. Doesn't mean it's going to do anything, because I'm not predicting anything. I'm not predicting what's going to happen to the euro. I'm not predicting what's going to happen in the confrontation with Iran over nuclear weapons. I'm not predicting anything like that about what might happen, but I'm just providing a chart view. And you know that coming into today, and I have to say that I prepared this before I saw today's action, so you may think it's a setup and kind of misleading, but I did do all this work ahead of time to get it all set up and all that. That if we were looking at this particular chart of oil, you can see that it has had quite a long run-up, and the longer it has a run-up, it builds some energy on the upside. Remember our pressure point that we have up here, you're building up some pressure. That lid kind of keeps pushing down, and you got this high pressure area that, pushing down all the time. The more energy it builds up, because people haven't been able to do any selling. Well, we had the highest high a day or so ago since last June. We've had a long run, so we know, or we assume, if we're kind of one of those people that think about the alternating scenarios, that we are kind of overdue for a correction. And prices are going to resist advance, particularly when we have kind of a psychological mark of $100 oil to factor in here as a possibility. The more the price goes up, the less people are going to use, less gasoline they're going to use, and so you might have some less demand, could affect the price. A number of things that can happen in the market that can change the price scenario and cause this alternating up-down